Ed Yardeni is with us, President at Yardeni Research. Ed, good to have you with us here. Good morning. If you've been following the local state election results here, that's the big talking point, has been for the last 24 hours. So a comment if you want to on it. And of course, at the same time, we've got something happening globally as well. Fed Chair Powell on Friday pretty much all but confirming that the hiking cycle is done.
Well, I guess the interpretation of what's going on in India with the elections is that it increases the odds of political stability. Financial markets always prefer financial stability, political stability, if possible. It would also be useful to have geopolitical stability, but you can't have everything. We've got obviously a terrible war going on between Ukraine and Russia and between Israel and the Hamas. But so far it stayed regional. Your point on the Fed Chair Powell, he said we're very much into restrictive territory in the Fed funds rate, which basically means that he thinks that the Fed really doesn't have to raise interest rates anymore. And so the markets have gone from will there be one or two more rate hikes instead to will there be one or two or three or four rate cuts next year.
All right, that's important, Ed. The point you made about financial and political stability is something that the market wants and perhaps in all likelihood will get with these assembly elections. So as a global investor, right, as somebody who's watched the Indian markets for a long time, do you think this could be a big trigger for large sums of money to come into a market like India vis-a-vis a market like China for the next 1 year?
Well, I must tell you, my mother-in-law is doing a tour of India, and she absolutely loves it. So, so far the feedback is it's a great country, and one of these days I'll have to follow her and do the trip. But clearly, a lot's going right here for India. The political stability issue is important. The flattening and decline in interest rates, the fact that we're now talking about how much will interest rates fall instead of how much more they will increase, is good for emerging markets, generally speaking. The geopolitical situation really hasn't affected the price of oil. So as a result, that has not been an issue for India because the Middle East clearly is most important to the global economy from the point of view of the price of oil. So I think all's going quite well. China and India are economic competitors, and right now India is enjoying some capital flows that might have gone to China in the past. As a matter of fact, China's President Xi was in San Francisco recently, and he basically sounded like he was pleading for foreign investors to come back to China. But I think at this point, foreign investors see a lot more positives in the outlook for India than they do in China. China's got a terrible property bubble bursting problem. And I wouldn't want to say that too many times. It'd be a tongue twister, but I said it once. So they've got issues with the property bubble and the aging demographics. India doesn't have those kind of issues. And so I think India may very well be a beneficiary of more foreign interest.
Hi, Ed. Good morning from here in India. And whenever you decide to visit India, we'll be happy to host you here in the studio as well.
My pleasure.
In the past, you have mentioned that India is obviously the preferred market in comparison to China. And India has been a beneficiary of this China Plus One. I'm wondering whether or not India is going to be the only one. Maybe the next couple of years, global investors will want to allocate money to India itself. So my question to you is, in the pecking order among global equities, where does India, stand? Point number one. Point number two, there are rate cuts that are being anticipated. And you told us the last time as well that you believe the Fed is done. How many are you penciling in?
I'm thinking that we're not going to have a recession next year. I've been in the camp, the soft landing camp, since early last year. And as a result, I remained positive on the stock market, maybe too positive in the first half of last year, but it's worked out reasonably well since October of last year. But I do think that that there will be two cuts, not four. I think the U.S. economy's proven to be quite resilient. I think inflation's coming down, but I think the Fed's going to be very, very careful about reviving inflationary expectations. And so I think they're going to be cautious next year. So I see 50 basis points altogether. I wouldn't rule out 100 basis points, but more than that, I don't think we'll see.
130 right now, so we'll While the markets are markets, they'll recalibrate and adjust as we go along during the course of the year. Ed, great to have you with us here. Thank you very much. Appreciate you being
pleasure.
here on the program, as always.